Assalamualaikum dan selamat sejahtera. Today I will explain about the concept of national income. The first national income is gross domestic product. What is gross domestic product? Gross domestic product is a total market value of all final goods and services produced within a country in a given time or period. GDP can be measured by two prices, which is constant prices and current prices. And to calculate current prices is that current prices can be measured and calculated on the basis of prevailing prices, and constant prices can be calculated in the fixed price prevailing in the base year. GDP excludes all goods and GDP excludes all goods and services produced by Malaysian citizen working overseas, as well as the intermediate goods. The output produced by foreign workers in Malaysia, such as Singapore, Indonesia, or Nepal, will be included in GDP. Next, I will be explaining about GNP, Gross National Product. Gross National Product is defined as the total market value of all final goods and services produced by the residents of the country during a given period of time. GNP is the total amount of income earned by nationals of the country regardless wherever they are. So, for example, Malaysian who's working in Europe or America. Those workers that works in foreign country will be included in GNP. The calculating of GNP only final goods and services that satisfy consumption needs. For example, as the product has been finalized, those products will be in the supermarket or in the market for consumers to satisfy their needs. The value of intermediate goods and inputs will be excluded to avoid double accounting. Gross domestic product and gross national product both reflect to the national output and the income of the economy. The main difference between GNP and GDP is that GNP takes into account net income receipts from abroad. GDP is measured by national income equal to national output equal to national expenditure produced in a particular country. GNP, meanwhile, to calculate GNP is that GDP plus net property income from abroad, and net income can be defined in dividends, interest, and profit. The net income from abroad will make the difference between GDP, which is gross domestic product, and GNP, gross national product.
If you refer to your textbook in page 289, you can see how you can calculate GNP. GNP can be calculated by equal to GDP plus net factor income from abroad. And GNP can be calculated by GNP equals to GDP plus factor income received from abroad minus with factor income paid from abroad. That's all from me. Thank you.
Assalamualaikum everyone. So I'm going to answer for question 4, 5 and 6. Question number 4 asks us what is market price and what is factor cost. Okay, so market price is the current price in the market through the forces of demand and supply. Means that if you see the price at a supermarket or anything, market price is the price, while factor cost is the real price that are earned by the producer or seller. Means that the cost that the producer earn, the seller sell, is the real price of it. It doesn't add tax or subsidy or their profit. So how do we calculate an NPFC? An NPFC is net national product factor cost. So there are two formulas in here, which is an NPFC. We can calculate it by gross national product minus by depreciation, or if we have an NP market price, we can minus tax and plus subsidy, because an NFC factor cost is the is the prices that the sellers or producers get, right? Okay. So how do we change an NPFC to NPMP? How do we change net national product factor cost to net national product market price? So to change it, we need to add indirect tax and minus subsidy, because this is the price that is the customer get, and we must minus subsidy because subsidy is the money that the government gave to the producer, right? So we just need to the price the factor cost plus indirect tax. So that's how we change it to factor cost, NNP factor cost to NNP market price.
Assalamualaikum. Today I will be answering on 3 questions, that is 10, 11 and 12. So number 10 question is that what is transfer payment and the examples. The answer is a transfer payment is a one-way payment to a person who has given or exchanged no money, good or services. So basically it is where one party give another party payment or benefits without the other party even doing anything. This usually happens between two parties like government and us, the netizens. Example of transfer payment is that first is pensions, second is healthcare, third is student grants or scholarships, and many more that the government has given us, that is called transfer payment. Next, number 11, the question is what are other names for depreciation? So other names for depreciation based on our book is that capital consumption allowance, or the answer that I found in the internet is that other words for it is devaluation. So basically depreciation is the lowering of a currency value of one good from its usual or original value. For example, a car, when we first bought it, it will cost higher than after the value of it after about 2 or 3 years after we have used it. The value have depleted because of depreciation. Okay, so for the last question, which is question number 12, that is by using income approach, compute national income. Okay, how to compute national income using income approach? There are one formula, which is national income equals to GNP minus or subtract depreciation. So how do we get GNP? We get GNP by GDP plus net factor income abroad. Yeah, that's all. Thank you.